Hi, I'm Pedro da Costa, editorial fellow here at the Peterson Institute for International Economics. I'm joined by Adam Posen, president of the Institute. Thank you for joining me.
Thanks, Pedro.
So you've just come back from the Kansas City Fed's annual Jackson Hole Symposium, and I wanted to get your sense of what the general mood of the conference and what you took away from the gathering.
It's interesting, Pedro. I've been lucky to get to go the last 4 years, and it's gotten to be a really good conference in the sense that Fed Kansas City, Esther George, the president, essentially pushed out a lot of the markets people. There's essentially no markets people there. It's all central bankers, ex-central bankers, academics, a few other officials. And so the discussions get to be pretty serious, and people aren't really talking their book as they would if they were at a market interest. This year was a little funny because the last couple of years there's been a really clear theme. So 2 years ago it was taper tantrum and how the emerging markets were going to react, and the surprise that a lot of emerging markets were actually wanting the Fed to hike. Mm-hmm. Last year the theme was about should the Fed hike, shouldn't the Fed hike, a lot about unemployment. This year was more muddled. The Kansas City said, well, we want to worry about what they called resilience, which is the ability of the Fed to respond if there is another problem now. And that's a really serious issue, but it ended up being a lot of maybe 2 academic papers. And the chair, Janet Yellen, gave a speech at the start that was very calm.
Yeah.
Now, to be fair, she wasn't the only calm one. This was a much more calm set of central bankers than I've seen for some time.
Yeah, and so, one of the things, as you mentioned, the theme was designing resilient frameworks for monetary policy. But Yellen's speech seemed to, at least for the moment, write off any other advances in monetary policy thinking, and it pretty much stuck to the script that we're an inflation-targeting central bank, right, that just is aiming for 2%, and we expect that we're headed that way, and therefore we're thinking about raising rates. So there was no kind of different policy message from that. Is that a fair
assessment? I think you're right. I think that's a very fair assessment. The chair's speech, first third was basically saying the economy's on a path. I think the famous quote is something like, the case for tightening is stronger. It's gained strength over the last few months. It was a very clear, mildly hawkish, as the statement goes, message. And the latter 2/3 of the speech were focused on some recent research by the Fed, which obviously the chair had stimulated, saying, okay, if something terrible were to happen to the U.S. economy right now, could we respond as the Fed? And their answer was a pretty calm yes. We could do a lot more QE, which our colleague here at Peterson, Joseph Gagnon, has argued would still work, and I think is largely right. But they, as you said, Pedro, they dismissed, or the chair dismissed some things. So Fed Chicago president Charles Evans had spoken about, well, maybe we should wait until inflation rises before we act. Fed San Francisco president John Williams had spoken about maybe we should have a higher inflation target so there'll be more room to cut next cycle. There were a lot of people, including me, obviously, who were talking about negative rates as a tool. And the chair very quickly dismissed all of those. I mean, some of them she clearly thought had a decent argument, but she just said they're just not relevant right now. We're not going to talk about them.
Yeah, that was interesting. And as far as, so do you think that the Fed sounded overly confident in the end? Because the sense in the markets really is that central banks, as much as they like to say that they have lots of ammunition left, that they've done a lot, and they are reaching perhaps the outer bounds of what their policy arsenal has to offer. Yeah. Do you think there was do you get a sense of complacency by the central bank?
I'm not sure complacency. It is difficult because you don't really want the central bank publicly saying, yeah, sorry, ammo, whatever happens, happens.
Yeah.
Unless that really is the case. And I think there's good reason to think that's not really the case. But there was, I think, in the chair's speech and a lot of the conversations around it, I think there was too much. They were too sanguine, was I think I would put it. They if we have to cut rates, but we don't go below zero and we do some QE, it'll be fine. If you're ruling out negative rates, if you recognize that unfortunately Congress has restricted the Fed and what it can buy in ways that other central banks aren't, then there's reason to be a little nervous.
Yeah.
A second thing, not to belabor this, is the chair did make a very realistic statement that a number of her colleagues has made, that what they call R star and Y star, the trend rate of growth, Y star, meaning productivity growth, and R star, what's sort of the neutral interest rate, what you would be, the interest rate you'd end a tightening cycle with.
Yeah.
Both have come down.
Yeah.
And that's a recognition of the reality that we're not growing as fast and we're not likely to grow as fast for a while.
That's the more dovish side of her remarks, in the sense that even if she might be talking about the case strengthening for near-term hikes, she's suggesting that in the long run, they're not going to go that far. Is that correct?
Well, I don't want to call it dovish. You're right that what she is saying, as Fed New York President Dudley said a couple of weeks before, we're only going to raise rates only so high, not up to 400 basis points the way we usually do, maybe 300, maybe a little less.
Yeah.
But it's not dovish because, as Stanley Fischer, the vice chair, said just a few weeks before also, if this is as fast as the economy can grow, then we feel we have to raise rates now because we don't want to go too fast and get inflation because it's not going to be sustainable.
Okay.
And that was actually one of the surprises of Yellen's speech, is that she pretty much agreed with that point of view.
Yeah.
And it's a perfectly legitimate point of view. But there's starting to be people both inside the FOMC and outside, like Larry Summers, Paul Krugman, and others, our own Olivier Blanchard, who are arguing there's sort of what you could call positive hysteresis. If you run the economy hot, you may actually be able to raise the growth rate, not just temporarily, increase productivity.
Including by perhaps bringing some of the people who have fallen out of the labor force back in.
Exactly.
Like
And the chair, presumably speaking in her role as chair of the committee, not necessarily her own personal view, pretty much ruled that out at present.
And did you get a sense, given these limitations in monetary policy, that central bankers are more inclined to discuss the need for greater fiscal policy action? And if so, which countries do you think are either inclined or that should be doing more?
Yeah, I mean, this is something which, as you know, we've talked about a number of events here, and he passed, not just you and I, past Peterson Perspectives you've conducted here at the Institute. Essentially all the logic for fiscal expansion is there. If you're not Greece, if you're not Argentina, the interest rates are incredibly low. Nobody's panicking in the rich countries. There's huge amounts of public and private investment that have been foregone in recent years. Central banks are able to keep rates low. So why not spend? Why not do this? And then there are people, again, like Krugman and Summers and Brad DeLong and others who go further and say, you actually crowd in private investment. So there's a whole really solid set of arguments for why you might want to do this. And repeated G7, G20 communiques keep saying, yeah, everybody should do fiscal stimulus instead of monetary. Too much monetary causes inflation, causes asset bubbles, it's bad, let's do fiscal. So anyway, what you said is right, that there was a pretty strong message, not just from Chair Yellen, but from a number of the other central bank governors at the meeting, that we really wish fiscal policy would take over, we really wish fiscal policy would do its part. Of course, the flip side being an independent central bank is you don't set fiscal policy. Right. It's elected parliaments that do that.
And you're shy about even proposing that because it's not your mandate.
Yeah, that's why you're absolutely right to raise it, because it was striking how much the central bankers did this. And to the Fed Kansas City's credit, they set it up so the main luncheon speaker was Chris Sims of Princeton, who is a Nobel laureate. And he actually used the occasion to make a, for my taste, very theoretical, but anyway, argument for why, in the end, you need fiscal policy, not monetary policy.
Interesting. And as far as the sense from overseas, of course, one of the factors that's kept the Fed from raising rates is not just a domestic outlook, really. It's primarily actually risk from overseas. First it was China, and then they became worried about Brexit. What was your sense from the overseas central bankers and speakers at the conference, since this is, of course, a very international event?
Yeah, there's I don't remember the number, but there's several dozen foreign central bankers, including from Latin America, Africa, East Asia, South Asia, Australia, as well as Europe. I think they're much calmer than they've been. Now, again, that doesn't mean everything's wonderful. And it was worth noting that the Chinese government, for the second year in a row, did not send a senior official from the People's Bank. They're the only ones not to for the last few years. So maybe that's a signal. But, among the Latin American governors you spoke to, the Asian governors you spoke to, even the European governors you spoke to, there was a sense, things aren't that bad. Now, that's a relative statement.
Yeah.
So Augustin Carstens, the very distinguished governor of the Bank of Mexico, Central Bank of Mexico, was one of the closing speakers, and he said, well, you guys have ignored emerging markets these last few days too much.
Yeah.
And we, Mexico, are able to weather the storm. That's because we take tough measures, and others have to take tough measures. And
even they have had a quarter of negative growth.
No, it's not been easy. And Governor Kuroda of the Bank of Japan made it very clear that he intends to do more and push more. But there definitely wasn't the sense of anxiety or pressure that one saw at central bank meetings over the last several years.
Sure. I guess the further away you move from the crisis epicenter of 2008, the calmer
Absolutely.
the mood gets. So.
Absolutely.
Thank you so much, Adam. Appreciate the update.
Thank you, Pedro.